Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another Cambridge Financial Podcast. I hope that all of you are having a wonderful day. We're doing much better here in South Florida after Hurricane Irma, so we're recovering nicely and we're doing the best that we can under the circumstances. Today, I want to start our podcast with a question, and I think this is a critical question that all of you should take into consideration as you prepare for retirement or other areas of your financial and investment world. And the question is, what if you could have an investment that would be totally unaffected by market volatility, regardless of what happens in the stock market? It won't have an effect on your investment. What if you could have an investment that was totally unaffected by interest rate volatility, unaffected by wars and or geopolitical situations, an investment that would be backed up by the top-rated insurance companies in the world? What if you could have an investment that provided true asset diversification, and that means that that investment is not correlated or is not tied to any other type of investment that you may have in your financial portfolio? What if you could have an investment that had regulatory oversight to make certain that, things were done according to guidelines and regulatory rules for the benefit of the consumer? What if you could have an investment that had historic above average market returns? What if you had an investment that you knew what the known payout would be in the future? Usually the future for these types of investments are anywhere between 4 to 10 years, and that's a payout window. What if you could have an investment that you could maximize your internal rate of return without having to deal with the volatility of all the other issues that are facing America today? Here's another question. What if you could purchase real estate or real estate property that is valued at $5 million and you were able to do that for $2.5 million? How long will it take you to raise the money to buy a $5 million property for $2.5 million? That in itself is what we're going to be talking about today. And the investment that I'm going to be discussing with all of you and educating you on is called life settlements. Now, the first question should be, well, what is a life settlement? And for many of us that have never been in this type of business, it is very difficult to understand. So what I'm going to try to do in this podcast is to give you an idea as to where the market is, what are the opportunities, what are the risks that are involved in investing in life settlements, and most important, the viability and the opportunity that most of us have to diversify, invest for growth, and maximize our internal rate of return over a 4 to 10 year period. So the first question of what is a life settlement? Pretty basic. It's a regulated financial transaction that is a legal right for the life insurance policy owners. In other words, it is the sale of a life insurance policy that is either no longer needed, wanted, or desired for an amount greater than the cash surrender value of the life insurance contract, but less than the actual death benefit. In real terms, the insured and or policy owner of the policy is paid a discounted value in cash in exchange for transferring the ownership of all the policy and beneficiary rights to a new owner or investor. Now, you would ask yourself, well, why is this market growing? And I think there are a number of reasons why the life settlement market is growing so rapidly in the United States today. Number one is continued market volatility. Yes, over the last couple of years, the stock market has been doing well, but prior to that, there was a lot of volatility. I remember many of my clients in 2008, 2009, 2010, many of them, when they came to see me for the first time, had lost a tremendous amount of money in their portfolio. And if they had to retire at that point in time, things were going to be very challenging for them and their families because the market was heading south, their accounts were heading south, yet they needed to start to pull money out of those accounts, and then obviously compounding the negative effect that was creating at that point in time. Is there going to be market volatility in the stock market in the future? Absolutely. Is there going to be interest rate volatility in the market, in the banking industry in the future? Absolutely. So obviously the continued market and interest rate volatility is forcing clients to start looking for other opportunities that are not correlated or related to those areas of the industry, and therefore they want to create diversification. Another reason for the growth in this market is that investors are searching for viable alternatives. They're looking for other types of investments that are not your traditional stock market, mutual fund, bonds, and real estate investments that we have been talking about for many, many years. Another issue is that policy owners are now aware of life insurance market potential and the fact that they do have the ability to sell their life insurance policy out in the marketplace. And I think one of the major areas of growth for this market is the fact that, the 65 plus population in the United States, the growth is tremendous. Actually, according to forecasts, the growth by 2030, which is just around the corner for all of us, the growth of the 65 plus population is going from 50 million today to 70 million by the end of 2030. Now, I want to kind of give you a little bit of the history of life settlements because I think is critical to understand where it came from and how we got here. And I think what's truly interesting to understand is that the life settlement industry has existed, at least in the United States, for the past 3 decades. So I would say anywhere between 25 to 30 years in which the market has really taken off. And I think that is driven primarily because of the baby boomers and the population growth. But its origin goes back to the 1911 United States Supreme Court decision, Grigsby versus Russell. And in that decision, the Supreme Court gave life insurance policies the characteristics of property and upheld the right of policy owners to treat their life insurance contracts as an asset. It had never happened before that period. So in 1911, the United States Supreme Court pretty much said, look, life insurance contract is an asset. Whomever owns the asset can do anything that he or she or it, because many a times the policy may be owned by a corporation when it comes to that. So therefore, the policies could now be sold in the secondary market rather than having to surrender or allow those policies to lapse for non-payment. Up until that time, and many years after that, many clients that have no need for a life insurance contract at a given point could either surrender their contract to the insurance company and get back the net cash surrender value if it was a permanent policy, or they could just stop making payments and the policy was going to lapse at some point in time in the future. So those are things that made a tremendous change. Now, although it was done in 1911, it really hasn't taken off, till the mid to late 1980s from a business perspective here in America. Now, who are the key players in this marketplace? Obviously, The key players in this marketplace are your hedge funds, which have done a tremendous job for many, many years. They're actually primarily deal at the institutional level. You also have insurance companies. Yes, insurance company owned hundreds and hundreds of millions of dollars in life settlements as part of their investment in guaranteed portfolio. You also have investment banks. Large investment banks invest a large percentage of their portfolio in life settlements. And the same goes for pension funds. Some of the largest pension funds in the world, like the New York State Pension Plan, the California State Teachers Retirement Plan, or CalPERS, which is the California Pension Employees Retirement System, they invest a portion of their portfolio in life settlements. As far as individual investors we may know of, Bill Gates, it's a major player in this marketplace. And so is Warren Buffett. Warren Buffett has over $600 million invested in life settlements as a way to hedge other investments that he has through Berkshire Hathaway, which is his major company, and it's a public company along those lines. Now, there are two sides to the life settlement business. One is investing in policies, and this is the podcast that I'm doing for all of you listeners today, because investing in policies is a win-win for the investor. Looking for uncorrelated investments in the marketplace. In other words, investments that are not attached to any single index or indices or anything along those lines. And then the other side is selling a policy. And that would be a win for the policyholder. So now a policyholder has the ability to sell the policy for a premium out in the secondary market instead of just using the traditional way of either lapsing the policy or surrendering the policy for cash value. Now, one of the major questions that I get from my clients when we engage in creating a life settlement portfolio deals with, why insurance companies don't want you to invest in life settlements. And the reason is quite simple if you understand it from an insurance company perspective. Number one, 90% of all life insurance policies lapse and no death benefit is ever paid. So whenever a policy is lapsed, it provides a huge profit for the insurance company. Now, obviously, all of that goes into their pricing arrangement, but if 90% of all life insurance policies that the industry sells, they're either going to lapse or they're going to be surrendered, and therefore a death benefit is never going to be paid, that's a win-win for whomever issues those contracts. For example, in 2012, AIG, which is one of the largest insurance companies in the world, their life settlement portfolio made up more than half of all their life insurance in-force business. So that's an enormous amount that they have on their books. And right now there are 20 plus states that actually require insurance companies to disclose life settlement options to policyholders wishing to either lapse or surrender their policy contract. So there are some states that if you live in one of those states and you own an insurance policy and you either want to lapse it or surrender it, the insurance company is required to give you a third option, which would be the ability to sell your policy in the secondary market. Now, one of the main reasons why we create life settlement portfolios for our qualified clients is because we want to provide true diversification along those lines. And most of the clients and or investors that I have reviewed over the past 28 years thought they were truly diversified until 2008. So if you had a portfolio of, let's say, 2 to 3 different mutual funds, and you had another 2 or 3 different bond funds, most clients and investors thought that they were truly diversified. And they found out that was not necessarily the case. And the reason is that in mutual fund portfolios, many of them have a very large overlap of traditional mutual funds that created havoc during bad years due to the fact that most mutual fund investments contain stocks of similar companies. So you may have 2 separate mutual fund portfolios, and between them, they may have some of the same companies in their individual portfolios. So when you look at them, you feel that you're diversified when in reality you're not. Now, most important, even with a portfolio comprised of, let's say, 5 to 6 mutual funds, they all contain stock market risk at different levels, whether we're talking about stocks, bonds, mutual funds, annuities, and real estate. Most investments are linked to economic conditions, market and interest rate volatility, investment banks volatility, and overall economic forecast. So even though you may have a portfolio of up to 10 different portfolios or 10 different investments inside the portfolio, there's going to be a tremendous overlap between one and the other. Now, that doesn't happen with life settlements because it is a non-correlated asset to all of these true diversification issues that I've been telling you about. Now, the rate of return, the primary factors in life settlements for rates of returns are the discount at which the policy is purchased, the premium payments, and time of maturity. Maturity meaning when the person that sold the policy eventually dies. Remember, when someone sells a policy and someone buys it, the person that purchases the contract paid a premium. So if the policy death benefit was $5 million and they paid $2.5 million for that policy, when that insured person eventually dies, then at that point in time, the investor that purchased the policy will receive the $5 million. Now, the sooner the maturity, the higher the rate of return for the investor. And the longer the maturity, the lower the rate of return to the investor. Historically, investors in life settlements can expect to receive double digits rates of returns by investing in a number of life settlement policies. Pretty much similar to a mutual fund, except that a portfolio of life settlement policies is called a private placement memorandum, or a PPM, meaning that a group of investors get together, they buy a number of life insurance policies, and obviously people are going to die along the way at different times and different places, and it kind of reduces the risk of putting all your eggs in one basket. Now that we get to the point of risks, what are some of the risks associated with life settlements? Well, all investments have risks associated with them. So it doesn't matter where you put the money. There's going to be market risk, interest rate risk, inflation risk, liquidity risk, economic risks. So for instance, I have clients that bring me their statements and they have $100,000, $200,000 in a CD at the bank. We all understand that CDs today are barely earning 2%. So there's a liquidity risk, obviously, because if you surrender that CD, you purchase, a 3-year CD or a 1-year CD or a 5-year CD. If you surrender that CD prior to maturity, obviously there's going to be a penalty you're going to have to pay. The other major issue is going to be inflation risk along with liquidity. So in other words, if inflation is right now, the CPI is at 3%, but obviously inflation is not tax deductible, so you have to add another half a point to a point and a half on that, depending on your tax bracket. So if the inflation and the tax on the inflation is 4%, and you're only earning 1.5% on your CD, you're actually losing money every single year because your interest rate acquisition is not keeping up with the purchasing power loss of inflation in 2017. So that's a major issue. Now, life settlements have liquidity risks because life settlements are set up for growth. They're not set up for income. We at Cambridge have other alternative investments that we provide our clients with that are earmarked and designed for interest and income, not for growth. Life settlements is for growth. Now, life expectancy of the policies that are purchased in this marketplace is anywhere between 24 months and 120 months. And that means that clients are expected to die between 24 months and 120 months after they sell these contracts. Now, life settlements also have premium risks. And the reason for that is that the purchaser of the contract must continue to pay the premium until such time that the policy matures and or the insured person in the contract dies. Now, obviously, from that perspective, life settlements and having their premium risks that could actually could be minimized by investing in a private placement memorandum. And what that does is that whenever you invest in a PPM, which is a portfolio of a number of policies, some portfolios I've seen with 10, 15 policies. Other portfolios I've seen with 25 to 30, 40 policies in a portfolio. What that does is that the private placement memorandum or the portfolio itself will maintain adequate premium reserves in escrow to make premium payments through the maturity of the contracts. Now, in a PPM, in a private placement memorandum, numerous investors are pulled together into a partnership, and they must be accredited investors only. And the definition of accredited investors are individuals or families that earn at least $200,000 of income annually and or have at least $1 million of assets excluding their personal home. So this is not for everyone, but at Cambridge and in my investment portfolio with the number of clients that we have here, we have many clients that fit the profile of accredited investors, and those are the ones that purchase into these private placement memorandums on behalf of their own portfolio and investment assessments. Now, private placements are securities, and they're structured through Regulation D exemption, and the rule on that exemption is Rule 506. So these are investments that are structured, they're regulated, and so forth. Now, one of the main questions that I get from clients is, well, Bert, this seems a really, really good investment, and I like the potential rate of return. Although we tell our clients that it is fairly feasible to obtain double-digit returns on life settlements, I like to under-promise and over-deliver. So whenever we talk to our clients and we do hypothetical rates of returns, I'm always using anywhere from 6 to 8%. But listen, if you can get 6 to 8% return, maybe 10%, 12%, but on the average, let's say on the conservative side, 6 to 8% return on a portfolio that does not have the impact of all that negativity of volatility in the marketplace and interest rates and stock market and so forth and geopolitical activity. I would argue that most of those investments would do very well just by earning 2 to 3%, maybe 4%. These obviously do much, much better than that. But the big question isn't that they ask me is, well, if it is so good, why haven't I heard of life settlements before? And the reason for that is that the majority of transactions in the life settlement business are institutional in nature. The average investor has no access. Obviously, Bill Gates or Warren Buffett, the hedge fund managers, insurance companies, they're large investment banks. They're very large institutional investors, and they use these contracts in order to reduce volatility in their portfolio and by also creating an uncorrelated asset program inside the large investments that they hold. And then the other issue is that most financial planners cannot offer set investments to their clients because the companies they work for don't want them to take additional fiduciary risks from any business perspective. Now, another issue is, are life settlements similar to real estate? Well, in many ways they are. And obviously in other ways they're not. So when we try to do a comparison between life settlements and real estate, think of it this way. Let's talk a little bit about the upside potential. So in real estate, the upside potential is the increased property value. So if you purchase a property today for $500,000, the upside potential, if the property goes up to $700,000, obviously that would be an upside potential in investing in real estate. In a life settlement is known as the payout. So the difference is that in a life settlement, you're purchasing a policy for $5 million, or a policy that is worth $5 million, and you purchase it for $2.5 million. So at the time of death, you, the investor, or the private placement portfolio is going to receive a $5 million return or a death benefit proceed. So they pay $2.5 million. So the gain on that would be $2.5 million minus their investment fees and so forth. So that is one of the areas that is very similar to real estate. Now, there are also constants when it comes to any type of investment. So in real estate, the major constant is, well, you have to pay real estate taxes and you got to maintain the property. You have maintenance cost. In life settlements, it's premium payments. So if you buy a policy today and the client is 85 years old and it is forecasted based on the statistical data and all the research that has been done on these policies that the client is going to die in 2 years, well, you have to have reserves to pay the premium for the next 2 years to make certain that the policy is available at time of death. Now, there are also risks when it comes to real estate and life settlements. In real estate is primarily the unknown future values. I remember in 2008 when the real estate market dropped as well as the stock market, many clients that I engaged at the time had lost a tremendous amount of money in real estate. Many of them were upside down in their property from that perspective. In life settlements is unknown time. So remember, in real estate, you already have the property. You just don't know what the future value is going to be. In life settlements, you know what the future value is going to be. You just don't know when that policy is going to pay. So the one risk there would be the unknown time. And then obviously the fact that it's an illiquid asset, obviously, and that premium payments may have to be paid. One of the reasons why we promote PPM or private placement memorandums to qualified investors only is because of the fact that when you're in a pool, the pool does a very good job of setting monies aside in escrow in order to pay the premium, thus reducing the liability for the individual investor in the portfolio. Now, another question is what types of investments can be placed in life settlements? Well, you can place non-qualified money. That means any money that you have available that you have already paid taxes on. So if you have CDs, money markets, savings accounts, where you have plenty of money in those and you want to earmark a portion of that to invest in life settlements as a long-term asset, you can do that. So CDs, mutual funds, bonds can be used every single day of the week in order to diversify the portfolio and invest in life settlements. And over the long term, they should do much, much better than the internal rate of return on those portfolios. And then the second type are qualified investments. And this is one of the areas where many of my clients are taking advantage of from a business perspective. So for instance, if you have a 401k, you have an IRA, you have a pension plan, you have anywhere between 5 to 10 years before retirement, it makes a tremendous amount of sense to put a portion of that money, as long as proper planning is done and the due diligence is done by our firm to make certain that you qualify as an accredited investor. It makes a lot of sense to diversify the portfolio and put a portion of that investment into a life settlement investment portfolio from that sense. Now, as I said earlier, and this is something I want to reiterate, the investor qualifications, in other words, the accredited investor qualifications, are critical to invest in life settlements. And again, an accredited investor is someone that has $200,000 of combined annual income or $1 million of assets excluding their personal home. So if you have a husband and wife, as I deal with the majority of the time, if they generate $200,000 of income and they have sound emergency funds and they have their planning in place and they don't have a tremendous amount of debt, I do, in that situation, do recommend that a portion of their investment goes toward life settlements. Other clients, they may not make $200,000 a year. They may make $100,000, $150,000, but they have at least $1 million in investable assets. And those same clients we set up portfolios for that will take, again, a portion of their assets in order to maximize the return of the portfolio over the long term. For qualified investors, the opportunities are tremendous, and they're really, really good from a business perspective, because if you understand life settlements, you understand that you have an investment that is unaffected by market volatility, unaffected by interest rate volatility, unaffected by wars and or geopolitical situations. I mean, take a look at what's happening around the world today with Iran and North Korea. What if we have to invade? What if we get into a war? Well, obviously the stock market is going to take a hit. Most investments in the United States are going to take a hit. Life settlements are non-correlated, so life settlements will continue to work the same way regardless of the market situation that we may have at that time. Now, the other thing is that these investments are backed by some of the biggest insurance companies in the world. And it does provide true asset diversification, because these assets are not correlated to any other investment, as we've said before. Historic above average returns, they pay out, so there's a known payout, 4 to 10 year window. And again, I think at the end of the day, one of the questions that my clients ask themselves is, well, what if I could purchase a real estate property that is valued at $5 million and I could purchase it for $2.5 million today? How quickly would I do that, and how many times a week would I do that? Well, I do it for as long as I have money. I would do it every day. If I can buy an asset that is worth $5 million for $2.5 million. So these are some of the critical aspects of life settlements that makes a tremendous amount of sense. Now, from an investor, from a policy holder perspective, think of it this way. Let me give you an example. Let's say you have a policyholder that is now 85 years old. They're not as healthy as they once were, so they're not, they may not be doing as well. They have a $3 million life insurance policy. They have in that policy, let's say, $500,000 in cash values. But they no longer need the policy. They owned a piece of business. They sold the business. They no longer have it. Their family are well off. They don't need, obviously now with the estate tax being as high, or the credit being as high as it is today, they may not need it as long as their net worth is under $12 million or around about that number. So they no longer need that contract. Now, up until 25, 30 years ago, the most this individual could do is surrender the policy, get $500,000 back. He or she would probably pay income taxes on the difference between the contributions that they made to the contract and obviously the growth on that cash value. If there was no growth on the cash value, then that would be a return of principal, so they wouldn't have to pay money on that. And obviously they would just surrender the contract back to the insurance company and they would receive their $500,000. The other thing this person could have done in the past was, stop making the premium payments, because this client may no longer afford or may no longer want to make those premium payments. And then obviously the cash value would continue to keep the policy in place. And obviously from 1 year to the next, the cash values would diminish because of the fact that the entire premium is coming out of the cash values, and eventually the policy would die. Now the question is, would the policy die before the insured does? And obviously that's a big risk that the client would have to do. But in the same scenario, what if the client could go out to the secondary market, to companies that specialize in purchasing these life insurance policies, and now after these companies do their due diligence, they come back to this policy owner and they say, Mr. Policy Owner, your death benefit is $3 million. You have $500,000 in cash. We're willing to give you $1.1 million. Most of the time, after negotiations, this client is going to walk away, sell the policy to this company for $1.1 million. Now, this policy holder now that just sold the policy could take that $1.1 million and invest it. They can use it to maintain their standard of living. Many a times they're going to have to use it for long-term care services and so forth. But the key for the insured is that he or she now has the ability to sell the policy for a premium and not have to surrender that policy to the insurance company. Again, I hope that you have enjoyed this podcast. And remember, our number one job is for you to change the way you see things, because when you change the way you see things, the things you see change. Feel free to reach out to me or my company for any additional information on life settlements, which is one of the major alternative investments that we are geared to be able to provide to our accredited investors, clients. Have a great day and a great weekend along those lines.